Paul Brown here from Wealth21. There's a number of changes starting from the 1st of July 2017 with regard to superannuation. So this presentation just covers the main changes. Important, got the disclaimer here, important to seek advice before taking any action on your superannuation. So seek advice from either ourselves or a qualified financial advisor. Just an overview of the 5 areas that I'll be covering in this presentation. There's been a reduction to the concessional contribution caps, a reduction to the non-concessional contribution caps. There's changes to the taxation on concessional contributions for high income earners. That's a Division 293. There's also changes to taxation for transition to retirement or TTR pensions. And we've also got the introduction of a new $1.6 million pension cap for retirement income streams. So looking firstly at concessional caps, we have the annual cap on concessional contributions is reducing to $25,000 for all taxpayers. Under the current rules, the cap is for people who are aged 48 or under on the 30th of June 2016. The concessional cap was $30,000, and for people aged 49 or over on the 30th of June 2016, the concessional cap is $35,000. For all people now, from July 2017 onwards, the cap will be $25,000. So things to consider before 30 June, potentially increasing your salary sacrifice contributions or personal concessional contributions while the higher cap is still available. After the 1st of July 2017, we need to look at adjustments to salary sacrifice and personal concessional contributions to take into account the lower cap. And there could also be some insurance arrangements that need to be reviewed where the premiums are included in the cap. So moving on to the non-concessional caps now. The non-concessional or non-deductible contributions, the annual cap is reducing. So the current cap is $180,000 for everyone. So the change that's being made is the cap is reducing to $100,000. But people who have a balance of 1.6 million or more in superannuation, so that's their individual balances in superannuation, will no longer be eligible to add non-concessional contributions. 3-year bring forward rule continues to apply for those people under age 65. So things to consider before 30 June 2017, the cap, the 3-year bring forward rule, 3 years at 180,000, 540,000. So there'll be some people considering adding up to the 540,000 to use that higher cap prior to the 1st of July 2017. For people over age 65, the cap is $180,000 though. Then after the 1st of July 2017, we need to look at making adjustments to non-concessional contributions to take into account the lower cap. And also for people who have balances over $1.6 million in superannuation, they're no longer able to add non-concessional contributions. Next issue is tax on concessional contributions under Division 293. So there's very few people where this applies to. For clients with income plus the concessional or low tax contributions exceeding $300,000, they currently pay the 15% additional tax on their concessional contributions above that level. So from 1 July 2017, that threshold is reducing from $300,000 to $250,000. So there's going to be more people who are caught under that Division 293. So for people in that position, potentially look at before 30 June, potentially bringing forward your personal deductible contributions where appropriate. And after July 2017, we need to look at reviewing and adjusting contributions, salary sacrifice contributions, taking into account the change to that or the reduction of that cap. The next point is the taxation of TTR pensions. up until 30 June 2017, all income from pensions, whether they be account-based pensions, TTR pensions, are all exempt from tax. So the change that's applying is income and realised capital gains on assets supporting TTR pensions will be assessable to pay tax within a super fund after 1 July 2017. So the things to consider before 30 June 2017, if a member has actually satisfied a full condition of release since commencing the TTR pension, we should look at converting the TTR pension over to the tax-exempt account-based pension. And after 1 July 17, for people who have TTR pensions, we just need to consider the benefits of retaining that or potentially rolling it back into accumulation, taking into account all of the changes that apply. And the final point is the transfer balance cap of $1.6 million. So we've got a new transfer balance cap which restricts the amount of benefits that can be used to pay retirement income streams. And that transfer balance cap includes existing income streams at 30 June 2017, excluding TTR pensions, and also any new income streams that commence on or after 1 July 2017. So there's, again, there's not a lot of people where this applies to, but for those where it does, before 30 June, we've got to look at reducing the total value of retirement income streams to less than $1.6 million. That will often mean rolling part of a pension account back into accumulation phase or withdrawing amounts, but generally it'll be rolling back into accumulation. Where applicable, we also need to look at the transitional CGT relief, resetting the cost base. That's very complex, so for those where it applies, we'll go through that in detail. After 1 July 2017, before commencing any new retirement income streams, everyone needs to consider their personal transfer balance cap before starting any new pension accounts. So that covers the main changes. There's a number of other minor changes and complexities. But if you do have any questions, please feel free to email me or call our office. So thank you very much.